Have you lost your money recently trading cryptocurrencies? Guess what? You might be able to reduce your tax burden by thousands of dollars. So, stick with me as we go over all you need to know about crypto capital losses in this video. We'll clear up a few common misconceptions and outline how you can report capital losses on your tax return. The United States Internal Revenue Service decisions from 2014, which classifies cryptocurrencies as capital assets, is the main source of inspirations for cryptocurrency tax rulings around the world. Cryptocurrencies are therefore handled similarly to stocks, bonds, and other capital assets. Cryptocurrency will be taxed every time it is sold for a profit if it is viewed as a capital asset. If you use cryptocurrencies to make a purchase and the value of the item you bought increases over the course of the year relative to the price you paid, you will be subject to capital gains tax on your spending. Let's imagine, for illustration purposes, that a person buys $100 worth of Bitcoin and holds onto it until its value increases to $1,000. After that, they purchase gaming equipment with $1,000 worth of BTC. Even if they spend the full $900 at their first $100 purchase had generated, a capital gains tax would still apply. According to the IRS rule, a $100 initial purchase would still result in a taxable profit. This because the IRS views most cryptocurrency users as investors. So long as your initial investment generates a profit, you must pay cryptocurrency tax regardless of whether you use it personally or sell it. You wouldn't have to pay taxes if you sold or used your cryptocurrency at a loss. Let's go back to the earlier illustration. For instance, your taxable gain is $900 if you bought Bitcoin for $100 and sold it for $1,000. You wouldn't owe any taxes if you sold your $100 worth of Bitcoin for $50. Additionally, you might use your $50 loss in Bitcoin to offset gains from other investments. So, how much taxes do you pay on crypto? To be clear, the IRS does not classify cryptocurrencies as money, but rather as property. Because of this, cryptocurrency sales and purchases in the US are both subject to taxes. This means that all current tax laws that apply to the property also apply to cryptocurrency, except real estate tax laws. In tax return forms for 2019, the IRS added a yes or no questions regarding cryptocurrency transactions. As a result, it is against the law and will result in a fine if any money from the sale of cryptocurrencies is not reported. Depending on how much your Bitcoin assets increase in value and how long you retain them, different tax rates apply to them. Your income tax rate will therefore be determined by your current tax bracket when you submit your earnings to the IRS. If your cryptocurrency profits are large, your tax bracket will also be modified, which could increase your tax rate on other non-crypto earnings. How to calculate your cryptocurrency taxes? As previously stated, the taxations of cryptocurrency owners living in the United States depends on two things: their income and the length of time they have held their cryptocurrency. Let's talk about how long cryptocurrencies should be held. The holding period for cryptocurrencies officially starts when a person buys them and ends when they are sold, traded, or otherwise disposed of as capital assets. If it's a short-term capital gain, a holding duration of 365 days or fewer qualifies as a short-term holding period for short-term capital gains tax. Depending on your existing tax bracket, these gains will be taxed comparably to your regular income. While if it is long-term capital gains, tax rates will apply to cryptocurrency held for more than 365 days. So, how do you pay your cryptocurrency tax? Cryptocurrency owners in the US have access to several systems that make filing and paying taxes simpler. Sites like Coinly, Crypto Tax Calculator, CoinLedger, Accounting, and CoinTracker are a few of the popular tax reporting and payment choices. Some people seek the advice of tax experts when they have complicated taxes, whether crypto or not. These professionals include tax attorneys, enrolled agents, and certified public accountants. Now, is cryptocurrency losses tax deductible? As mentioned earlier, cryptocurrency losses can be used to reduce crypt taxes. This implies that losses in cryptocurrencies are tax deductible just like other capital losses are. This implies that by disclosing such losses on your tax return, you can use cryptocurrency losses to offset some of your capital gains taxes. You may claim capital losses up to $3,000 annually. Losses over $3,000 may be rolled over to subsequent tax returns for future capital gains tax deduction. Taxes can also be reduced by making charitable donations with cryptocurrency. Also, cryptocurrency profits are taxed similarly to gains on capital assets. Even if you don't receive any cash from your cryptocurrency profits, you are still obliged to pay taxes on your gains. The selling price of your item must be deducted from the cost price to determine your crypto gains tax. The resulting amount is your profit, which you might have incurred from trading or holding onto the asset for a time. Following that, your cryptocurrency tax liability will be calculated using the rates and holding times. So, do you need to report crypto if you didn't sell it? The acquisitions of cryptocurrencies is not taxable. This means that you are not compelled by law to record and pay taxes if you are merely hanging onto your cryptocurrency. Even if a cryptocurrency is increasing in value, there is no tax on owning it because there is no immediate gain or loss. How about transferring your cryptocurrency between wallets or exchanges? Also, these transfers are not taxed. They are exempt from reporting and taxation. However, it is taxed if you get cryptocurrency as income, such as a salary or reward from a blockchain enterprise. The fair market value of the cryptocurrency at the time you acquire it must be determined and the resulting sum must be taxed. As long as the value of the gift is less than the yearly gift tax exclusion limit of $15,000, receiving cryptocurrency gifts is a non-taxable event for both the giver and the recipient. The same goes for the inheritance of cryptocurrency. Does the IRS know if you own cryptocurrency? The short answer is yes. The IRS is working harder than ever to find cryptocurrency owners who haven't been paying their taxes. A task force on cryptocurrency compliance was established by the IRS in 2019, and more than 10,000 American taxpayers who may have neglected to declare their cryptocurrency holdings and gains received letters as a result. However, as it stands, Form 1040 requests that taxpayers disclose their cryptocurrency-related activity. These actions include purchasing, selling, sending, trading, and receiving digital currency. Therefore, the likelihood of an IRS audit may be increased by failing to declare crypto activity. How do NFT and DeFi taxes work? As of now, decentralized finance is not directly included in current IRS rulings on cryptocurrency tax. However, because DeFi and yield farming contain cryptocurrency, they might still be subject to the standard crypto asset tax restrictions. Taxes on non-fungible tokens work the same way. NFTs are most certainly taxable as property under current IRS regulations, even though the IRS has not yet issued any guidance on how to tax them. This means that if you sell an NFT, you will have made a profit and must report it as a capital gain. Can you avoid crypto tax? There are many ways to avoid paying taxes on your cryptocurrency gains, like donating it to a good cause or giving it as a gift to friends and family. These techniques can help you lower your tax obligations and are entirely legal. Platforms like the Giving Block make it easier to donate cryptocurrency to nonprofit organizations and relief programs like Mental Health America, the Children's Cancer Associations, the Ukraine Emergency Response Fund, and others. Donors can also choose to donate cryptocurrency to causes like empowering women, supporting children in the cryptocurrency community, or helping animals. Nevertheless, declaring cryptocurrency-related activities and paying cryptocurrency taxes on time is your best bet for avoiding IRS audits and fines. Holders of cryptocurrencies can avoid any inconveniences that non-filing or non-payment may result in this way. So, how can you inform the IRS of cryptocurrency losses? The IRS Form 8949 allows you to report any cryptocurrency losses. Many investors think they don't need to report anything to the IRS if they solely experience losses rather than gains. This is incorrect, and the IRS is clear that any losses on crypto transactions must be disclosed on your tax return. Calculate your gain or loss from the transactions and enter this information on one line of Form 8949 to report your taxable events. Once the lines for all of your taxable events have been filled out, add them up and write your overall net gain or loss at the bottom of Form 8949. Now, it can be time-consuming to calculate your losses for each crypto trade you make and report them on your taxes if you have been trading regularly. After all, cryptocurrency exchanges like Coinbase and Binance struggle to give their users reports on their gains and losses. This issue arises as a result of the interoperability and technical nature of cryptocurrencies. Exchanges might not always be aware of a customer's initial cost basis for a coin when they receive a transfer of cryptocurrency from one wallet to another. As a result, it is highly challenging for exchanges to determine capital gains and losses with accuracy. Investors use crypto-tech software to compile the entire history of transactions across all platforms, which is why this is a growing trend. Alright guys, that's all for today. If you found this video useful, please give this video a thumbs up and hit the subscribe button for more.